Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focused Compounding, sitting next to Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great for everybody else as well. If this is the first time you are tuning in, hit that subscribe button. Check out all the content we put out there on the internet. Go to focuscompounding.com. Best place to get access to everything we do is my Twitter, at Focused Compound. And hit the subscribe button wherever you are watching us. So, and I guess I got to plug QuickFS. Go to quickfs.net to get access to the software that we use to pull 20-year financial data. We use it every single day, and we also use it on the podcast as well to demo out everything we talk about. So if you want to look at what we look at, go to quickfs.net, sign up, and tell them that you came from Focused Compounding. Somebody left a comment on one of our videos that they don't think my heart rate ever gets below hummingbird level.
Oh.
And they didn't think that yours ever gets above 40 beats per minute.
Yeah.
So we're kind of like,
it works out
a little different right there. Yeah.
Hopefully
we
it
meet in the
works
middle,
out.
I think.
Yeah.
I think we meet in the middle, but I actually laughed out loud when I read that. So in today's podcast, we're going to talk about, I'm always tweeting out different things, like different sort of checklists. You ran up different checklists for investors. I think a lot of beginners, but also other people as well. It's good to kind of go through checklists of, the investing processes and stuff like that. And somebody actually emailed me going over something that, I don't know if I tweeted it out or it came from one of the blog posts or something like that, but I could tell it came from us, and he pretty much was asking some questions on it. So I thought it would be good to, kind of go back and revisit this and I guess just talk about, different things in this list. This I think came from, we were talking about 100 baggers, and he referenced 100 baggers. Let's just say this is for 10 baggers, okay? To get to 100, you first need to be
I like
a
to
10
think
bagger.
in terms of 10. We've talked about that before, yeah. You can do it twice.
It's a lower hurdle to go
Be a 10 bagger twice, that's 100.
Correct. Yeah, there you go. But first you gotta hit that. Yeah, exactly. Yeah. The first thing on the list is it a small enough stock? And I don't remember the exact questions that he had, but I do know, okay, does it need to be a very small stock? There are companies that have been, call it, 300 million or a billion that over time have become very valuable companies. Why is that the first thing that is on the list? I mean, of course, it's the area that we typically specialize in. And, as our asset base has grown, we're going to have to shift, and we have had to shift.
Mm-hmm. Well, if you look at, I guess you could say, Microsoft or Apple or something like that kind of scale. If you were looking for a 100 bagger, let's say, or 10 bagger, then you could have at 10 or 20 billion. So not a small company. But you can tell that there's only a small number of companies that ever get to the size of, let's say 100 billion. So use your 100 bagger, your 10 bagger example. If you can count the number of companies that are over 100 billion, you can run a screen to see how many there are in the US. Those companies, to be 100 baggers, would have had to be a billion or less. They would have had to be under a billion at that time. To be 10 baggers, under 10 billion. So, virtually all of them will have to be smaller than that size. I know this one disappoints people. They want to be able to find the 100 bagger or whatever that's already a 1 billion or $10 billion company. But yeah, they would be rare if they're that size already.
I was going to say, do you think more companies go from, call it 100 million to 10 billion instead of, a billion to 100 billion?
Yes. And we can also see that in terms of the way that market caps are distributed. So actually depending on how you define a microcap, almost most stocks at any given point will be a microcap. So in terms of the market, most investors' money is, they have a small percentage in microcaps. So they might have 5% of their money in microcaps. But those microcaps as individual stocks are accounting for more than 50% of the number of stocks out there. So in terms of the number of opportunities, I'm not saying they're all good. It doesn't say anything about whether they're good or bad, but it just says that there's more of them. So there's just more choices that you could have there. So, it's kind of like saying, if we're saying who would have the big, who would have the biggest increase in their fame or something. If we go by actors that you can name already, that's not as good a pool because they're already pretty famous. Sometimes it does work out that way. And it will in a few cases. But in many more cases, there's lots of people that you vaguely know that actually will be the right answer. And so it's more likely to be a company that, that's smaller, that you vaguely know, because there's a lot more of them.
Sure. It'd be interesting. And it's sometimes when we, are having these conversations live on the podcast, I'm like, wow, that would be a pretty interesting study. I would like to see, so for example, go to the book 100 Baggers, right? Or 101 in the stock market. That's another book that's kind of dedicated to this topic, or it is dedicated. And in both of those books, they list a lot of companies that have been 100 baggers. So 1 to 100. And it'd be interesting to see the evolution of the company from the early days to where it was when it hit that 100 bagger status, and how much the company had changed. So did they eventually grow into something else? Is it still very much the same line of business? Like, what happened in between for them to get there?
Yeah.
Like the actual business, like the products, what they're doing, etc.
Right. We could definitely look at that. I remember looking at a few and kind of figuring it out. So the ones that nothing changed and they hit it big and were a big success were drug companies of the like biotech type variety, and mining and oil. Okay. So they already had the asset. And then it turned out they developed it, and it turned into a big hit.
I mean, Monster Beverage would probably be very similar.
So that's the other
Same
one.
thing. They just
it can be one brand, exactly. Yeah. And so that's the one that you can have, right? There's a few retail things that just expanded across the country. Those are kind of the Peter Lynch type things where he talks about, whether it's La Quinta or Taco Bell or whatever, something that he sees that he thinks, okay, this can go across the country, There's those, and then there's others that are, would be capital allocation things that you'd never predict. That'd be hard to predict. And then there's others that grow into markets that you wouldn't know the market was as big at the time. So, obviously if you thought, okay, if you thought, that every personal computer is going to have a Microsoft operating system, that would have been a really big market, but it wouldn't have been anywhere near what it turned out to be because you have underestimated, household demand and things for that, for private computers as opposed to servers and things like that.
But the perfect example, look at Berkshire. It grew into something completely different.
Yes, and those are very, very unusual. It happens with
how do you handicap that?
Right, based on that person and being able to do that. People are always looking for the next Berkshire Hathaway. There are some examples. There have been more in the conglomerate era and stuff like that. And there are there are really some examples. They kind of changed what they did. But if you go read books about, let's say Ted Turner, Sumner Redstone, people like that, it developed out of something totally different into a big company, Rupert Murdoch. In some cases, the stocks did well, but not as amazing because like Rupert Murdoch or something, there was a lot of debt used and then also shares issued and stuff like that. But still, of course, he got very, very rich.
Next one on our list is the multiple low enough.
Yeah.
And a good way, you could screen out a lot of things as well is you could invert. And, the inversion to that would be is the P too high to avoid multiple contraction while you own it.
Yes.
So if you're going to buy something at 40 times earnings or 50 times earnings, are you factoring in multiple contraction?
Yeah, when you talked about...
to more of a normal market multiple, call it whatever you want to call it. I don't know normal nowadays, but, less than 40 and 50.
Yeah, when you talked about 100 baggers, I think from what I remember of what he talked about, number he talked about was kind of like 50 to 60 PE. Being that a 50 to 60 PE, that kind of thing, something with a 50 PE, could have a really high PE and might not be something you want to overlook, but you don't want something that has really higher PEs than that. Those aren't the kinds of things that we would be looking at. Generally, those are very high PEs. So I guess what he was saying is that his point wasn't that it has to have a low PE, certainly. Everyone would always perceive a 50 PE, even in days gone past, a 30 PE, but a 40 or 50 PE as being high. But it's not the same as paying a ridiculous price versus something. So, things like Starbucks and stuff had high PEs throughout their growth phase. Yeah.
3, does it grow fast enough? So obviously you need growth.
And you can do the math on that. So how fast do you want your 10 bagger, your 100 bagger? If it grows at 7%, then it's going to be about, that you're going to have doubling every 10 years that way. So you can use the rule of 72 kind of approach. We talked about 240. That's an easy way to do it. So, if you want a 10 bagger that's only growing at 10%, then you're going to have to wait about a quarter century.
So Geoff just inverted that. Is the growth rate too slow to ever produce a 10 bagger? Yeah. Number 4. Now, this is something that we talked a little bit about with Investors Title Company, right? Is it self-funding? And that's very important for...
I think that's critical. Now, there's some instances more recently where I guess we'll see. It may work out for some companies that they can turn into like Hunter-Begg or something without having been self-funding. But historically, if you look at the history of business, it's very hard to have to create a really big fortune without being self-funding.
Self-funding from retained earnings of the company.
Now, we did talk about some of the examples where they aren't. Mines, oil fields, biotech, not self-funding. If you hit it big, so a few things have to happen. So one, you have to have a long enough runway that you can somehow raise money from outsiders and dilute and borrow money and all of that to the point where then you can have a big success and then you can keep enough of that. And so those are the sorts of things that you see with people trying to do that, Chesapeake Energy or something. You're relying on borrowing a lot of money and for a very long phase. And sometimes it's very, very long, then it can become a problem. I'd say most companies that have been successful historically, even tech companies or whatever that people think of, became self-funding much earlier than a lot of investors think. We've talked about some that, worry me or whatever about that they haven't made a profit for a really long time, haven't generated cash flow from operations. And people compare them to, Amazon and Facebook and whatever. Those companies were actually generating cash flow from operations relatively fast compared to any of the things that we talk about today that way.
Do you think it's interesting? I think like a simple heuristic, I'm kind of curious to get your opinion on it. So a lot of companies in our world, for example, more of the overlooked space, they don't have any analysts that follow the companies. And I wonder, do you think in that space there tend to be more self-funding type of companies? Because companies, that are microcaps, for example, that may have analysts following it, it's probably because they need extra sources of capital to fund.
If you don't have any analysts following you and you're not turning a cash profit, you'll go bankrupt.
Exactly.
Yeah, because otherwise they'd be covering you because they want to do deals. Yeah. So if you can't interest anyone in deals, you better become self-funding right away. Yeah. If you have a private business, they better become self-funding a lot faster.
People didn't see, but you actually laughed like halfway through my my question because I think you knew exactly where I was going with it.
Yeah. And you can tell when there's a lot of analysts covering something that they're interested in doing a deal. Yeah. I mentioned DreamWorks Animation before. They're covered by a ton of companies in part because they covered other entertainment things, but in part because they knew M&A activity and movie studio stuff is bound to happen, and it was a big deal that eventually DreamWorks will be resolved in some big M&A thing. Yeah.
Now, it doesn't need to be entirely self-funding, though. I mean, there are companies that we own that use debt, leverage.
Oh, I'm not. So I have nothing against
referring to shares.
No, I have absolutely nothing against financial leverage. I think I've kind of I give the feeling to people that I'm opposed to using financial leverage and things like that. I'm not. I'm warning about two things. One, if you're not self-financing, then you're relying on the kindness of strangers, basically. And so, when you read those books that I've suggested about, like, banks that failed or energy things or whatever, that there was a boom and bust. And they say things like, if we only could have made it a little longer, we would have made a lot of money and stuff. Sometimes that's true. But you didn't make it long enough because it was all bank money you were using. And, and if you had not been using bank money, if you've been using all your own money, you never would have gotten to that size. But you also would have survived, at that point. And so that's, one part of it. The other part of it is, issuing shares and all of that we talked about. Now, if you have a big owner of the company from early on, they're not likely to want to issue a lot of shares that way. But if they're reluctant to issue a lot of shares, then they may have to borrow a lot. And if they borrow a lot, then there can be a real disconnect between the interests of the creditors and the interests of investors that way. Now, some companies you could argue can't be self-funding and stuff. This gets complicated. Like if you read Cable Cowboy, the argument's going to be that they used a lot of debt. They did use a lot of debt, but there's reasons for why you would do that. So one is financial things, just financial engineering. So that was like the John Malone reason. But the other reason why you would do it, this is why Cruise Lines did it and others have done it, there's advantages to scale. And particularly there's advantages, as there are in many industries, to relative scale. And that's the particularly scary one. So if there's a relative scale advantage, you have a problem, which is if you grow slower than your competitor will start to have high relative market share. If their relative market share is higher, then they may have economies of scale on a unit basis that are better than yours. And eventually you'll have problems like you'll be paying more for programming than they are and stuff. So in the long run, you'll fail by not using debt. It isn't really the case that you can grow your business as fast as you want to, but you have to actually grow your business incredibly quickly. So even things like cruise lines and cable companies, while generating a fair amount of cash flow from operations at times, each subscriber was quite valuable. There was a strong incentive to grow as fast as possible. The one I mentioned before is like when someone was asking about Netflix and their approach and stuff years ago. I was saying I wasn't opposed to them not reporting a profit, because if I was running Netflix, there's no way I'd report a profit. You got to get big as fast as possible. That was the only way they were ever going to survive, doing what they do. Yeah, because you're a middleman, on both sides that way. In terms of your programming costs and in terms of the audience that you're serving, you didn't want to be the second biggest independent streaming service. You want to be the biggest, because all your suppliers are people who don't want you in business. You know, yeah.
5, is the industry within one of your areas of expertise? Probably the most important item on this list.
Yeah, so I think for me, this is really important, right? I think most kinds of things, people would think, it's sort of like the Peter Lynch thing. People naturally, for whatever reason, think that the next big thing or whatever will be in something they know nothing about.
Yeah.
Right.
And I do see a lot of pushback on this, like on Twitter and stuff, with Buffett's like circle of competency and stuff like that, because people say, well, how are you learning? How are you continuing to learn if you don't ever step outside your circle of competency?
He has learned. He bought Seas, and so then he bought Coca-Cola. He became an expert on insurance. I mean, eventually he bought Gen Re. He got involved in insurance with Geico and stuff because Ben Graham just owned some of the company because he had done it as a deal that made financial sense. It made sense for Ben Graham. So he learned everything about insurance. But what we talked about with Buffett is like he actually owned an insurance company. He actually owned a bank. He actually owned a brand like See's Candy. So who would know it better than someone who actually owned those things and had someone, the CEO of that company, reporting to him? Then you learn a lot about it and understand it. This is where I talk about Man for All Markets and Fortune's Formula too, the Ed Thorpe stuff. I think where they talk about the Kelly formula and all that you can get into in terms of bet sizing and all that. One of the most important parts of that is the idea of having an edge. And if you really learn about that stuff, about what it was developed for, is information stuff. But having an edge in terms of the interpretation of information, that you have better information than other people. Well, how are you going to have better information? It's not going to be through insider trading and having access to a private wire, which is the kind of theoretical example of that. You have a hot tip on a horse or something. How do you know? What's the minimum amount of information that you need to know there too? And how much should you bet? Because you don't know the information is 100% good. In those cases, now, how can you have an edge over versus other people? It's probably the soft stuff, not the financial data, the hard stuff that you would see. And so it's by better understanding that business model, I think.
So soft science meaning what?
Understanding how the economics of that business work. Understanding, as an example, right? I mentioned DreamWorks Animation. DreamWorks Animation, let's say you're looking at a pure movie studio and you've never looked at movie studios before. Okay, they have a couple of flops in a row. All right, is that random? Because they only release a couple of movies a year. So if you have a terrible year, is that because you randomly had 2 flops, or is there something creatively wrong there, that things in the pipeline that are coming out now have been in the pipeline for 4 years, and we're in for a period of really bad creative output from a studio? Those are 2 completely separate things. 2 flops in a row could happen to any company, and statistically, the odds that would happen is pretty high. So it's nothing to get worried about at all. If the issue is that the stuff that they're putting out now is creatively really poor versus what it was before, and it's because of changes in the organization over the years, which has happened in plenty of places, then you probably want out of the stock unless they can sell it to someone quickly or something. Those are 2 completely different answers. It's important to know that. We look at Disney being a 100-bagger or whatever. That's something that you need to know. Is it a couple hits in a row or something when they have the strategy in the late 80s or 90s or whatever? Or is it something that they have for a really long time, or Pixar or any of those things? So you can see there's a really big difference. And some people might say, oh, well, you can't predict that. right? But some people can. It's in their circle of competence. To other people, it's just, oh, it's a fad, it's a hit, it's just random, it's whatever. But it's not. Just the way that, to some people it would be insurance or whatever would be, oh, this is just random luck or something. But it's not if you understand those things about it and how it normally manifests itself in those industries.
That's why sometimes you see a lot of CEOs, they're active stock pickers in their industry.
Yes.
So if they're in the theme park industry, then maybe they're picking stocks because they just understand their business.
I would say that that's pretty common that I've seen. Yeah. I've talked about that a little bit, where people talk about like insider trading and what it means, trading by insiders and what it means and all of that. And in my experience talking to people from the other side, which is, okay, I know that you work for a public company or whatever, when did you buy your public company and why did you do it? And what other stocks have you bought and stuff? It's actually the reverse of what most people expect, which is not that they had some information that other people didn't have. They had a feeling about the trends of the next 3 months to the next 6 months. It's actually that they had a really good understanding and really high confidence. And so when there was a dramatic price swing one way or the other in their stock, they thought, well, this is crazy. We're not worth twice what we were 6 months ago. Or they thought, this is crazy. We're not going out of business. I can tell we're not going out of business. I've worked at places before that were like this one and stuff. And so it's just, the confidence that you have from that, of being in a particular industry or whatever. And we talked about that with like, brands. A lot of that can transfer over, where you could predict that a brand would continue to be successful for a while. It's not perfect. None of these things are perfect. I mean, that's why I use examples trying to compare to things like, things that people think are totally unpredictable. So a lot of people would think an energy drink is totally unpredictable in terms of being able to know what will be hot in the future, or an alcohol brand or whatever, or what movies will be successful. But they're not. There's a science to it. It's not something that people can predict perfectly, but neither is what's the right rate to set on insurance. And so it's just something that if you dedicated your life to one area or another, you would have more information on that and be able to make bets on that.
Sure.
And it's not as different as people might think in whatever industry that you're in. So if you're in food or beverage or in industries of whatever things that way, and to some extent it's the same with picking people, as investors buying into a company that has some whatever person running it, there are probabilities involved in deciding what you think the odds are that they will do this or not do that, and that they're a good bet or not. It's not that people are just completely something that you can't evaluate the same way you can evaluate a PE ratio. And so are they sort of things that you can become more in your circle of competence or whatever of evaluating those things. And Buffett's become really good at doing that. Evaluating managers, having an idea of whether they'll stick around, having an idea of whether they're reckless or not, and those sorts of things, and whether they understand competitive advantage and all that. Yeah. And mostly from the outside, not without having to do a lot of interviewing of them.
Is it above average industry to be in long term?
Yeah, that's another one that I would say is big for me.
Yeah, very important.
As compared to
companies' positioning in the industry.
Yeah.
The growth rate of the industry. What else?
So
are they price takers?
Capital intensity of the industry is probably the biggest factor. I mean, how much is it likely to generate in gross profits versus the net tangible assets is going to have to tie up in it. The biggest warning is that you want to be very cautious about highly cyclical industries that have to have very high net tangible assets versus profits that they could generate from that. Now, there's some that have been a success. There will be examples in the 100 baggers that you'll find that there is an oil company and a mining company or whatever that has success with something doing that. But it usually requires putting in a lot of capital up front and then not knowing, how much money you'll make after that. If you have it at a really low marginal cost, then it's gonna, you're gonna be very successful and you can make a fortune that way. But in general, repeatedly making those bets are the tough part. And so industries where there is a long history of poor profitability that way is a problem. Now, industries can get rationalized. And so if their problems especially are kind of more structural issues that I think are not as basic, like there were too many competitors in it and different things like that, they might be solvable. Taking the oil example, some of the way that they built some oil companies had in part to do with greater integration of certain things and stuff. And so they actually made a lot of money in refining and things like that, and transportation and stuff like that. But that there were problems that, at other times from excess competition and everything. And so that competition had to be eliminated one way or the other, either through consolidation or through actually surviving a period in which others went under. And so those sorts of things can be fixed. And we've talked about that before. There's plenty of industries where we've talked about, whether it's railroads, airlines, lime, and things like that we talked about, where, you can go back 40 years and see that the economics were didn't look as good as they might look now. And they're, sometimes that means the stocks work out or they don't, but there are hints that things are better. And those things, industries can take a very long time to turn that way. And that's always the argument when we talk about whether a company's cyclical or not. And I say, well, what worries me is this looks like it's cyclical, whatever sort of thing. Obviously, the people betting on it are betting, no, it's a change. The industry is going to become a good industry now. It was bad in the past because there was, too much competition or something like that. Now it's consolidating, or now something about the cycle is changing. And that's sort of the key argument between the bull and bear positions.
Is this an above average company in that industry?
Mm-hmm.
Everything that we talk about.
So have you read the book Good to Great?
It's been a while.
Okay.
Yeah.
The big thing about Good to Great, which I think you'll find, or maybe the key thing to think about, is it's very rare. There's not a lot of good to great businesses. And some of the ones that might have gone from good to great then would have problems after that and whatever. So whatever people would think about the other book by the same author, Built to Last, that idea that things are born great or not is more true than people might expect. I think a lot of investors might expect that you can take a so-so company and turn it around and have a lot of success with it. In the short term, if you get a good price on it, that's true, right? So if you buy into a company that's kind of weak or whatever in an industry, but you get a really good price compared to other things in that industry, you can have a lot of success as a stock investor. But the big thing that I always see is like people doing a comparison of two companies in the same industry and saying, well, if this company's margins are the same as that company's margins, and they kind of assume capitalism just magically is going to work to make the margins the same. And I don't know why they think they're all going to be the same as the highest company's margins, right? Wouldn't they be the same as like in the middle?
It's not good for the modeling.
Yeah. Or if there was, there are some industries where it would be worse than that. It would be at what point would it actually be enough to take out supply of others, so it's going to be a lot worse than what the, in a normal part of the cycle, what the margin in the middle is. It's going to be, what does it actually take to put some of these people out of business? That's how low the price could go, how bad the margins could get. But yeah, so when we talked about Copart or whatever, so if there's a spinoff of something, they're going to compare it to Copart. If you have a food company or whatever, they compare it to the best food company that they can compare it to. If you have a alcohol one, right, they're always going to compare it to whoever has the biggest margins in that. I always would like to use at least 5 different companies and use minimum, maximum, median. It's nice when you get a situation where you're paying a minimum type price on a company and only incorporating into that minimum type margins or whatever. That's not normally how it works in the stock market. Usually you have to pay the highest price for the best business in the industry. So, paying a below average price would be good. But definitely you want, I think, an above average player in the industry. Yeah,
and that's what a lot of people ask, where they're like, okay, well, if it's above average company, isn't that typically known by the market? Thus you're paying a higher price for it or not getting a discount?
Yeah, but that's what I said about the Fortune's Formula stuff, about having an edge. You're only going to have an edge if you decide it's above average business when others don't.
It's like you want everyone to agree with you just a little bit later.
A good example is Nintendo lost money one year. They come out with the product after the Wii and stuff, and not so successful. And when they did that, they had reported losses for the first time in a very long time. They had a lot of IP. They had a lot of things that if you ask people around which things were most popular and all that, obviously the trends at the moment were not good for Nintendo. But there's all sorts of things that you could look at and say that they had a resilient position compared to others in the industry. A lot of goodwill built up, a lot of people who'd be willing to buy a product if they could put out a product that was as good as others that way. And a lot of, IP that they owned that they could use and all that stuff. So the question is is that a good enough industry? Historically, pretty bad industry. But they had made a go of it for a long time. And so then you just have to have a question of does this mean that it's going to get worse forever for them or not? And I feel might be kind of exaggerating and thinking that one flop is a problem, So it's that kind of thing. The same thing with Boeing and Airbus or whatever. They will have something where they have a disastrous project. It goes way over budget. It doesn't launch when it's supposed to. Those sorts of things. That when you're asking, is there a point where you could get it at a good price? Well, evaluating whether it's above average business shouldn't depend on one project, right? I mean, maybe, but some people may read into that everything's going badly for them now. If there's negative coverage for years on a company, people might start to believe that it's not a good company. That was kind of my example with the movie studio thing. If they put out a few flops in a row, so you got a year or two of flops, to stock market investors, they're pretty short-term oriented. They can't wait around that long. They think that will mean that there's a big change in the company or something like that. You know, same with cyclical type things or with insurers or banks or whatever. Goes a few years where their strategy, their approach doesn't get you as good results as someone else's approach, right? It looks like they have the wrong strategy. It may just be they have the wrong strategy for this point in the cycle. But most companies can't just switch their strategy every few years to be whatever's the best in the cycle.
And therein lies the opportunity for investors like us.
Yeah. So when I say above average company in the industry, I do mean researching and understanding it, like, is Progressive above average in underwriting? Not does Progressive's return on equity this year higher than their competitors. Their competitors might be higher this year if they made a mistake. That will happen. And is it a mistake that in some way isn't core to their like competitive advantage that they have that way? They've talked about banks a lot that way, like low cost of deposits and things like that. Like we're talking more durable sorts of things of above average. Not did they fail to jump on some sort of thing? Did they not make enough loans in this category that's growing really fast the last few years? You know, those sorts of things. I mean, I remember talking to someone and he said it was a few years after the housing crisis, but he looked at the last 5 or so years of the company. He said it hasn't grown for like 5 years. And I said, well, the last year there's 2008. So it didn't grow from like 2003, 2008. It was a bank. And I was thinking, did you really want your bank to grow really fast from 2003 to 2008?
Sure. Yeah.
But at the time you would have. And, you know, it still bothered him after that time that it wasn't a grower. So that shows you how strong the incentives are sometimes to do that. So I'm sure that there are people saying this is a below average bank in 2006. But was it a below average bank? You know,
or were they actually conservative?
Right. And so when you're saying that, like sometimes you can have a variant perception of like what is above average and below average in an industry. Because sometimes what people say is above average is just what's working right now. I mean, having the most marginal position in some commodity business is going to get you the best results in terms of huge increases in EPS, and you're going to look great in all sorts of ways in the year when you're in a real shortage in that commodity. But is that a strategy for the long term? And I think if you ask around in the industry, no one's going to tell you this is the best company in the industry, even though they have amazing profits this year because there's a shortage in what they sell. And their cost structure is such that now their EPS has gone up 1,000%. You know, investors could get fooled into that. But I think if you ask around the industry, most of the people won't say these are the best managers with the best, organization and everything.
8, is the management team better than most?
This definitely you can get into the
in microcap land. I would say it's probably it's very, 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 very important.
Microcaps, it's incredibly important. However, small and flat or whatever you want to call it, the organization, it's going to matter more what management's doing there. Yeah, and so it's going to obviously matter a lot less, and how diverse it is, how diversified it is, and so it's
like the business lines and stuff where they're getting their cash flow from.
Yeah, I mean it can't matter as much who's running Berkshire Hathaway or General Electric or whatever as it can. It can on capital allocation and some corporate decisions that way, but it can in terms of the strategies of individual business units or any of that. And there's strong, corporate values and sorts of things, not just in terms of the whole company, but in terms of each of those business units that is there, whatever the manager is doing. We talked a little bit about that, like if it's a turnaround or something that's different, because then you kind of get a lot of leeway to really change the culture a lot, and it's almost like it can be reborn. But absent that, it's going to be your smaller companies where management's going to matter the most.
What are your thoughts on related party transactions? You see more of that, I would say, in microcap land.
Yes. I mean, I think I'd say that they do worry me generally, especially when they're not necessary, that I don't understand why they would do it. I think a lot of companies do it where I would say, why are you doing that? It's just something to steer clear of ever having that as an issue. And I think there's not enough common sense applied by people who email me about it and stuff, worrying about this transaction or this one looks okay this way. It's like, are you taking advantage of these things? And so one of the examples I gave is like someone's, brother-in-law is on the payroll doing a job that does not seem to be critical to the company.
Sure.
Right. Yeah. That they wouldn't have much use for it. And they're paying them $200,000 a year or something. That might seem like a really small issue. It's not as scary as certain other related party transaction things that they have. It's just a family member who's at the company and stuff. But to me, that kind of thing can be very worrying of what else it means.
Well, it's like a culture, right?
Right.
Yeah.
But I've seen other ones where there's a company that's renting stuff from the members of the family and stuff. And when you look it up, it's like, if anything, below market type
People
rates.
do get worried when they see stuff like that. A little bit of
we
like
should be able
commingling
to-
and stuff.
right, but we should be
That's
able to
pretty easy
tell-
to verify, right?
Yeah, and so the issue with that is, so for instance, in that case, there are cases where I could understand why you would do that. You have a very small business. The family controls most of everything. There are ways that I can get to understanding why you rented part of something to them and paid them something for it. There are not so much as to why you have people at jobs that I don't think are real jobs, that sort of thing. And I think you can usually tell the difference between those when studying the related party transactions. Then there are other ones that are more complicated, and it would depend on how that would worry me, because obviously through related parties and things, you can have a lot of fraud. A really good example is if you rely on one supplier and that supplier is basically a related party and that there's some owner owns part of it or whatever. By doing that, that's a huge amount of your cash flows that pass through that, depending on the company. And so that opens up all sorts of different risks about fraud and things like that.
Kickbacks, stuff like that.
Yeah. But if you mean like that there's a related party thing because someone loan money to the company at one time, like a note or something like that there was for, a year. There are some very small companies where that would make sense.
What about when I've seen somewhere the CEO, they may own the building and then they lease it to the company.
Yeah.
And then, the company's paying them.
So some of those, so what would be legitimate, what wouldn't? A few things. One, I don't like to see, honestly, I really don't like to see when the owner owns a lot of another company in the same industry. That worries me, but it happens sometimes. So they're more like an investor who owns different companies in the same industry. Because then your incentives are all, all over the place that way.
Yeah.
But what you're describing, I think is not really justifiable usually. There may be some cases in which the activity of the owner in the industry predates the formation of the company. And then there's issues of how do we resolve this stuff, right? That's the only case where I can think of it being it. So the company was created later, and then the company was doing stuff that was related to the business that the owner was originally in. He started to devote all his time to that business. I've seen that. And then there's an issue of like, okay, now do I buy this thing? Do I buy the original store that you were in, the original restaurant or whatever that you had, when the chain that has this name or whatever isn't the thing that you first started that has that, then there could be issues there where it makes some sense. It's still kind of worrying that way. You would like them to kind of pull it all together and everything, but look at Berkshire Hathaway with before they pulled things together with Blue Chip and all, and Diversified Retailing and all that, where they would own different pieces and all. It was very complicated, and it's hard to figure out why didn't they all just put it together. But once you have that happening, there's a lot of work in putting it all together. I mostly am worried more about like the incentives of why they're doing things the way that they are. So are the incentives kind of to provide a lot of jobs for different members of the family, things like that?
This wouldn't be under related party, but I once spoke with a CEO who he was paid, whatever his $1.5 million a year salary, but he also had, it was like $1 million that was unaccounted for, is what they called it, where he could basically use on, whatever, private jets, hotels, like stuff like that every single year. Yeah.
Yeah. And, and some companies have things where it's sort of, they're small items, but they're a little odd in terms of they reflect a culture where you get certain status things in terms of perks that are purely there so that you have perks that are somewhat better than someone else at a different level and all of that. And you see that sometimes.
Kind of reading about Lights Out and the whole GE thing. Remember they would fly two planes everywhere they went.
Well, yeah, that. But GE is a really good example that way, even in the continued things to Jack Welch and stuff, what he had. And that's a lot about the titles and about the perks that you get and all that. A lot of it doesn't make sense because they're so small versus the amount of actual salary that you're being paid that there's no need for that. Pay them a lot of salary and then have them buy their own stuff.
Yeah.
Yeah. No, I'm all for that. I'm fine with, to some extent, I'm fine more with very large amounts of compensation than other people are. That doesn't bother me as much sometimes. So I've been asked about that. I was asked about that with something where they were like, does it bother you a lot this person makes all this money? And I mean, they insisted on, or, you know, however they accepted a lot more money than justifiably they would ever need.
Was it because the compensation committee told them, or
the compensation committee they appointed?
Or consultants told them. Yeah, there we go. That's what it was. Yeah. Well, the consultants told us that we should pay ourselves more.
I'm sure they're in the 49th percentile or whatever. So, but I did look at it and say, look, I have to ask the question of whether the company's worth more or less without them. You know, would I rather someone else take $1 a year and replace this person than this person be paid 20 million or whatever? And no, I'd rather the person be paid 20 million because the danger by any random person of $1. Having said that, do they really need to be? I mean, could they have gotten there for 10 million instead of 20 million? Probably. But usually, I mean, I can't think of cases where like paying someone too much is really as much as the problem as having the wrong person in the job. Mm-hmm. You could argue is that a justification for paying any amount to have the right person in the job, and there's a lot of right persons. It's not like there's only one of them. There's a lot that you could have. Most companies should not rely that there can only be one person running it. But I would be very worried about having just any random person doing that. I've said that before with a few companies. We've talked particularly about banks, insurers, and things, but also I remember very clearly the one with DreamWorks Animation. I would not have wanted any random studio, fired from some other studio head to be in charge of DreamWorks Animation, because there's just so few people who had experience in running that kind of a business as opposed to being part of a much bigger live action thing. So you just had a lack of enough people with knowledge of that industry. And, you could imagine the same thing. I wouldn't like to, someone was running some brand and now they're in charge of this insurance company. That doesn't happen very often, but you could imagine the problems that you have with that, with management. With some small companies, microcap companies and things, if you get the professional management can be really poor sometimes. So you are sometimes a lot better off with family control and things like that, or just like something that has much more connection of them as an owner.
Control companies.
Yeah, because otherwise it can be very hard to have good management. Mm-hmm. I'm not saying it can never happen, but it's much harder to attract really good professional management of a very small public company than it is at the much bigger public companies. Yeah.
And then our final one, are you paying a below average price for this business?
Yeah, I think that's important. Mm-hmm.
Which ties in, is the multiple low enough? We talked a little bit about it being a good company.
Right.
And, if it's a good company, how often do you get an interesting opportunity to buy it at a below average price?
Yeah, I think you get some opportunities, but that's true. But, we did the looking back at like Tractor Supply, and it was largely a huge, 10 bag or 100 bag or whatever, in part because of having a very low for any sort of growth stock PE. So, I mean, you can do the math yourself with that. The PE shouldn't be that much of a price if you think about it. If the PE is 100 instead of 20, that only cuts in 5 times into your, into your total return. If you're looking for a 100 bagger, that's not such a big deal. If you're looking for a 10 bagger, that is. But even if you're looking for a 100 bagger, you end up with something very different than what you were aiming for. It does matter, and the math is pretty simple that way in terms of your exit multiple versus what you think is your entry multiple versus what you think is normal as a way to exit. Mm-hmm. The big thing I see with most people talking to them is they kind of factor in that it will trade at the same PE it has in the past. That will not happen, because although lots of people will recognize the business over time, if it's a fast grower, it will be a much slower grower later, which means that you have to factor in it having a PE ratio like others in the industry.
Sure.
So you're looking at an energy drink company, it's fine to factor in that it'll have, if it stays high quality, the same sort of PE as Coke. It's not fine to assume it'll have a PE of a fast growing company, because once they get mature, there aren't fast growing companies because the overall segment isn't fast growing, and all businesses eventually mature into slow growing companies, Public utilities were a fast-growing industry at one time. Car insurance was a fast-growing industry. So if the world goes all to electric cars, then there'll be one day when the electric car industry grows at a few percent a year. That happens to every industry eventually, and that's good. That means you're business that you invested in was a huge success and everything, but it'll become a huge success and no longer a growth company. That's the end for all growth companies, is eventually they become huge. They go from being small growth companies to being huge mature companies that don't grow anymore. Yeah, I mean, like I said, in that book, I think higher multiples of 30, 40, 50 were okay. But that is a thing that I worry about. And certainly in the ones that I've had success with, we talked about Activision. Multiple expansion is a huge part of that. Huge.
A lot of the companies that we've invested in or you've invested in, like multiple expansion did play.
When I gave the example of
CSVI.
Example of Activision, that was a 100-bagger with only about maybe 12 to 15 times expansion in the size of the company. So it expanded about 12 to 15 times. It grew. It was a 12 to 15 bagger as a company, but it was a 100 bagger as a stock because the multiple expanded by like 8 times or something, and stayed expanded. I don't mean just for a moment. I mean it expanded and never went back. So it was re-rated as a giant company at a multiple in terms of price to sales and things like that. That was very high. So you can sometimes get 5 to 10 times of your return, 5 to 10 doublings of it, just from that fact of the multiple. You could imagine that. That does not mean buy the ones with the lowest PEs. Obviously, the ones with the lowest PEs on average have very poor growth prospects. The average very fast-growing company probably has a very high PE. There will be some things where there's a reasonable PE, and yet they grow a lot.
That's the hard part about investing, right? This is where all the art form comes in.
Yeah, but even when we talked about Progressive and Investors Title Insurance, in the last 10 years, they had like 10 times PEs or something, and we're growing 10% or more a year. It's not going to be the next thing that gets you a 100-bagger, but honestly, those are above average growth rates at below average prices. So it should beat the market. If you can find something that 10 times PE growing at 10% a year, it would be hard to be wrong about that for a really long time. That should work out if you're right about the growth rate and you buy at that price. The only way you're not going to make money buying things that grow at 10% a year is if you pay an above average price.
Got it. Cool. Well, I'm going to put this list in the description, so be sure to check that out. I want to thank everybody so much for tuning in with the both of us here today. Hit the subscribe button wherever you are listening or watching us. Go to quickfs.net to sign up to get access to 20-year financial data that you could pull in an Excel spreadsheet. Makes things really efficient and quick, and it's a nice visual that it creates for you, and you don't have to do any sort of number entering or anything. So go to quickfs.net to sign up for that and tell them that you came from Focus Compounding. I want to thank you so much for tuning in, and we will see you in the next podcast.